Good afternoon, everyone, and thank you for joining me today to talk about mortgage mastery. The information today will be general in nature, can't be construed as bespoke, customised individual financial advice. General disclaimer. Who am I? I'm Elizabeth Blake, a financial personal trainer, strategist, and coach, and I've been at Enable Me for 12 years, helping clients to have more financial confidence, be better and do better with money, save more faster, get in control of your money instead of it being in control of you. I've been looking to help people reduce their debt, short-term debt and mortgages, and to grow their wealth, and ultimately to get retirement ready. That is ultimately what we are looking to do when we're working with our clients. Today, we're interested in mortgages, and it's really timely because interest rates finally are starting to ease. And although it's not always about the interest rate, at least that provides us with a little bit of relief when we can start to think about perhaps making a plan if we haven't had one already. We're talking about the forces that we might think are holding us back. We're talking about controllables that we work with and how we're able to start thinking about perhaps bringing a different mindset to the game. And I have a client story of my own to share with you today. And hopefully there'll be time at the end for Q&A. The truth is that the old advice no longer cuts the mustard. We can't just rely on buying a very cheap house and being mortgage free on retirement. If we just do the old things that we've always done, it's just not quite going to cut the mustard. It is harder than ever to get on the property ladder initially. And once you're on the property ladder, it is hard to get mortgage free if you're not working in with a plan and having a strategy and being able to execute on that strategy. It is harder to retire comfortably, and it is harder for people to pay their mortgages off by the time they want to be able to retire. And ultimately, we all want to also be able to raise financially independent children, because that can be a big drag as well. If you're feeling the pinch, you're not alone. Many New Zealanders are finding that 49% of their income is going towards their mortgage. A few years ago, that used to be more like 35 to 45% of your disposable income was required to service your mortgage, but you can see that that is inching up over the past few years as interest rates have had an effect. 56% of New Zealanders report that they're living payday to payday, and 59% of Kiwi mortgage holders are reporting that they're suffering from mortgage stress. This is a feeling. It's to do with the economy, the market cycle that we're in, and as I've mentioned, interest rates, and just generally the cost of living and life's curveballs that come along. But some of this can just be a perception. I mean, if interest rates were the thing, then we all would have got ahead way faster when interest rates were 2 to 3%. But most of us didn't. But that's not a reason to not try. Scarily, in the last 6 years, 15% more of New Zealanders over the age of 65 are still retiring with a mortgage. And also, as scarily, that sum of debt has gone up about 50% from 17 billion to about 25 billion. So the stakes are high. Is there any hope? Yes, I'm here to tell you today that there is plenty of hope. Conditions are improving. We do think that interest rates will continue to ease next year, but ultimately we don't rely on external factors. We have to make our own plan and rely on our own skills and abilities and seek support where appropriate to make and implement and execute on the plan. And what better time than to start right now? I know that we're coming into Christmas. Frighteningly, that's only a few weeks away. But actually, I'd like to suggest that the best thing, the best gift that you could give yourself is the promise promise of a better financial future. And that might start with coming and seeing us for a consultation. You'll be invited to at the end of this presentation. I think your future starts now, your plan should start now. And as I always say to my clients, if in doubt, just take the next small step. We don't, as I said, we're not going to just rely on interest rates dropping or just kind of hoping that things will work out. There are much more powerful levers that you can pull. And your plan starts by knowing your starting point. Where are you at right now? Don't bury your head in the sand. Clarify that with yourself. Where are you actually at? Be honest. Write it down. Where are you trying to get to? What's your end game? It will be different or might be different for everyone. How long have you got? That makes a difference in the levers that we have to pull in order to get you to land where you need to by retirement. What hand have you been dealt with? What are you dealing with at the moment? What levers can we bring to play that are going to fast track your progress? For most of us, that comes down to three things: maximizing your position, maximizing your surplus money, your savings, what is left over at the end of payday. We're always looking to maximize that and improve it as best we can when we're working with our clients. Then we want to be smart with your mortgage. We want to eliminate as much short-term debt as possible, of course, but we want to be strategic with your mortgage. We want to reorganize it and be tactical with it so that you have a clear pathway of how you're going to be able to eliminate your mortgage before retirement, in fact, years before retirement, saving yourselves tens or if not hundreds of thousands of dollars in interest that you no longer have to pay the bank. Well, that would be a great thing, right? Once we've got a handle on that, then we'll always be looking to bring into the conversation, how can we grow more wealth for retirement? And that will mostly come down, where possible, to using leverage. What we do know, though, is earning more money most often does not necessarily translate to more progress. You might think it does, but what that actually can lead to is actually more fritter and really just lifting your spending to meet your extra income. From years of working with our clients, we know that financial success is made up of strategy and execution. So you've got to have the pathway and the plan and the tactics and the strategy and the knowledge about where to go, and then you've got to actually implement it. That comes down to you, of course it does, but the coach is there to help show you, guide you, and show you the light about how to get there. So step one, maximize your savings. And some of us might be at the little piggy bank stage and some of us might be at the big piggy bank stage. But ultimately, we do this by strengthening your financial foundation. Your financial foundation is really initially your money habits is the foundation at the beginning. It's like the foundation of building the house. We have to understand what makes up your money personality so that we can work alongside you to maximize how you manage your money and to give you appropriate guidance and suggestions of how you might be able to do that better. We will provide you with a structure and a framework that we have used for years that we believe to be a platform for success with our clients. And we will help you manage your money and maximize your cash flow as best we possibly can. The foundations, the strong foundations, are everything. Think of your money habits as that foundation. The goal setting is so important to provide what we're aiming for. The cash flow management we want to maximize, and we want to look at your mortgage strategy and bring our smarts to that so that we can really make your money work smarter for you. It has to be the hustle. So we want to understand your money personality because your money personality informs your spending and savings habits. Are you a shopper, a saver, or somewhere in between, a plotter? People can have elements of everything, but generally a shopper is more energized by spending money, whereas a saver is more energized by seeing money grow. And that might be a great thing, but we also have to suggest that they might need to take a little bit more risk in order not to pass up opportunities. And a plotter is kind of a little bit of both. They can save money okay, but they tend to reward themselves for that good savings behavior by spending it. We want to understand your approach to risk, which we define as a safety warden, an adventurer, or a dreamer. A safety warden can sometimes go hand in hand with a saver, so they will tend to be more risk averse. And as I mentioned, the trouble with those type of money personalities is that they tend to avoid taking any risks. And so we want to help them understand that taking informed, appropriate risks can sometimes be the game changer for them to meet their financial goals. An adventurer is going to be more comfortable with risk. And so what we have to do there is just ensure that that risk is well thought through, is appropriate for their age and stage, and that we manage their situation appropriately. And a dreamer can sometimes be quite hard to work with initially because they tend to have less of a grip on the realities of the financial world, and sometimes can think that the universe will just provide. And occasionally that might be the case, but mostly it is better to have a bit more of a solid plan than that. We'll also be interested to understand at the beginning where you're at with your cash flow management and your situation, how you're feeling about money at the moment. We tend to ask if you're sinking, floating, or flying. So sinking might be that you have short-term debt, you're using credit card to prop up your overspending, or you haven't really got a good understanding of the money that you are spending. Your floating is that you're doing okay, you're managing to meet your obligations as you need to, but you sort of have a sense that you possibly could be doing a bit better or getting ahead a bit faster. And a small percentage of people, when we meet them, are flying. So we define that as saving about 15 to 20% of your net income. But we can usually also bring strategies to bear to play into those type of clients and help them fast track, accelerate their progress and grow their wealth faster. So knowing your starting point and your natural tendencies will help to optimize your cash flow and help us to understand what strategies we need to bring in order for you to maximize your cash flow situation. Over the years, we've come to understand that Kiwis might be frittering about 15% of their household income, which we can usually find quite easily. And our coaches embrace the desire to find that fritter in a way that allows you to still live the life you love, but just to get ahead faster, because it's money that you're spending without it actually adding anything to your life. It's money that we can usually capture quite easily. These are some of the suggestions of where we might see fritter, but we always can find that fritter for clients, which is very validating and rewarding. And of course, we then want to use that fritter and the maximizing of the savings in order to crush the mortgage. That's the next step in the plan. As I mentioned, it's not about the interest rate. It's actually about having a plan and sticking to the plan. And it's about increasing the pace or the cadence at which you can save money and start to achieve your financial goals. We have some ways that we can look at your management of your mortgage initially. People often ask us, what's the difference between a revolving credit or an offset mortgage? A lot of people we meet have the offset situation. With the offset, I quite like that if you're offsetting someone else's money. An offset is just where one account has savings in it and the mortgage interest is charged on the difference between your mortgage balance and the offsetting savings. So you are reducing your interest, but you're not actually paying your mortgage off faster. So if you're offsetting it against someone else's money, perhaps parents or family members, if it's okay with them, or a business where money can't be actually touched, then I quite like that as a strategy. But otherwise, we really like the use of a revolving credit facility. The main reason we like the use of a revolving credit facility is that you can re-access your progress if you need to for something that you might have saved separately for. We want to really incorporate your savings onto the mortgage, but in such a way that you can re-access the money. And when we're working with our clients, we have a tactical way of using revolving credit so that it is specifically linked to what we come to know about you, and so that the target that you are looking to repay at any one point is sustainable, it's measurable, it's achievable, realistic, and time-bound, because it's directly linked to the money that we know, if you're following our plan, you can pay off that revolving credit in that specified time frame. So we really do like that as a tactical way of getting ahead faster, but being able to re-access your money if you need to. So it forms part of the strategy. We might also look with the rest of your borrowings. Do we need to refinance you to a new lender? Is that going to be beneficial for you? They might give you a cash incentive, or your situation might be a little bit messy, and by refinancing, we can speak to the new lender and get everything set up optimally at the beginning with specific targets in place and a structure that really speaks to your goals and your situation. And for each person, it will be slightly different. If we can't refinance, it's not beneficial to refinance, or there's a reason, then we'd look to either refix or restructure. So refixing, that's quite a simple transaction with the bank. You're not moving banks, you're just accessing, hopefully, a lower, better interest rate. Minimal paperwork can be done really online. If we're restructuring you, then we've got an opportunity to speak to your existing lender to perhaps get better terms, change loan terms, have a new duration, implement the revolving credit structure. We just want to have the maximum amount of flexibility, and also have the structure that gives you specific targets to clear in each period, and give you the maximum ability to achieve your goals. I wanted to share one of my favourite clients. I met them a few years ago. They are still with me. They told me at the time that they thought they were financially fit, but one of the things I remember about them is they were spending about $700 a week in restaurants, and they said that was their non-negotiable, because we always ask our clients, what's your non-negotiable? Which I said was outrageous, and I said if they could trim that a little bit, I could get them mortgage-free in 12 years instead of 30, which they thought was fabulous. So they signed to work with us. But they actually did it in 4 years, which was amazing considering all the things that they did as well. Some of them are listed here. And I did want to add in that they also had some setbacks. So they did some amazing things. They paid their mortgage of $700,000 off in 4 years. They also purchased through us 2 investment properties, which they still own. That's a long-term hold strategy. And they went through, I think it was 2 periods of redundancy as well, not just one. So pretty amazing results. And our coaches are excited to know that these are the types of results that we get all the time with our clients. So once we've started to look at a bit of mortgage strategy, we don't need to wait till you're mortgage free. We're going to be having a conversation about how can we re-access the equity in your home and use leverage. As I say, we don't have to wait until you're mortgage free on your home borrowings. We want to see pretty much as soon as we think that there is opportunity there and the bank will lend you money, we want to discuss whether an investment property can be or is right for you. Why do we like investment property? Well, we like all forms of wealth creation strategies and all asset classes. But the thing about property is that you can benefit from leverage, in that the bank will lend you all of the money, and you keep all of the capital gain as long as you hold it for the required period. So in that way, it outperforms other asset classes simply because you're able to buy a much more expensive asset at the beginning. And it also does tend to have less volatility than other asset classes. Here's a quick example of how wealth strategies don't just end at retirement. So in here, you can see the blue line is a client paying off their mortgage. Instead of by 65, they're going to do it by the age of 55. What that then unlocks is the green line. So that is all the money that they no longer have to put into their mortgage. And then their KiwiSaver, of course, will come in on retirement. And the retirement funds alone might have lasted them till they were 80, which is pretty good. But if we can have a wealth strategy, such as an investment property that you can hold in retirement, then we can bridge that wealth gap and push the money out so that it doesn't run out until you're aged 90. So that's a very generalized, idealized version of what we're looking to do when we're thinking about getting rid of the mortgage and then leveraging to buy an investment property. Step 4, of course, what we love about working with a coach is the accountability piece. And this comes up all the time with clients that are looking to re-sign and re-sign and re-sign. You don't just have to stay with us for a year. We've got many clients who've been with us for years, and it's not because they didn't get it right the first year. It's because they grew, they had extra exciting goals, and they really were keen to keep the accountability going, because we know that you're much more likely to achieve your goals if you are working with a coach and you've got that accountability. I like that quote there from Tom Landry on screen now. The job of the coach is to help you execute, to increase the odds of success, to build a buffer which will ultimately minimize the risk and improve your resilience. And we really just want to keep you accountable to that goal and to your future self. So takeaways, we wanted to understand the habits and tendencies. Your starting point doesn't define your end, but I'd really like to suggest your starting point could be now. Your tendencies indicate what strategy might be effective for you. We have years of experience of working with clients in this arena. We really just want to understand what you are capable of, not just what you're doing or even what you think you're doing right now, because most people have no idea what they're actually capable of until they start to make a plan and start to work towards their goals. So I would like to invite everybody today to attend an initial consultation with one of our strategic coaches who will meet with you and discover where you're at and where you'd like to get to, and help you explore ways that we might be able to work together in order for you to land where you would like to and need to. There is an offer today for a discounted consultation, normally $400. It is $149 if you book today. If you book tomorrow or in the future, it goes up to $249. So great deal today. To make contact with enable.me, you can go to the website with the information that's present on the screen now, or you can scan the QR code as well. I think we do have time for a couple of questions. I'll hand over to Amelia to ask those.
Thank you, Liz. Our first question is, any recommendations on how someone can improve their rate of saving to pay off the mortgage?
Yes, I think hopefully I mentioned a few in my presentation, but I think to improve your rate of savings, the first thing is to understand where you're at. So write down what income is coming in after tax and KiwiSaver. Write down everything that you absolutely cannot avoid spending money on. I think we all know what those things are. Hopefully there is then some money left over, and then it is a case of making some choices and understanding what for you is genuinely non-negotiable. And then it's a case of having to work out what of those are you prepared to forego? Hopefully there will still be money left over after that. So it's a case of reorganizing your mortgage into a tactical strategy so that you can start to chunk your mortgage down. I think the use of a revolving credit facility is a good one, as opposed to just having, a floating loan that you can make lump sum payments on. The difference there is that you can't re-access the progress if you need to. But the key thing about a revolving credit is it has to be very structured, and there has to be guardrails in place, because most people's objection to revolving credit is that it just feels like a revolving door with money going in and money coming out and people hovering near the limit. And so you actually need to have a very specific plan of how you're going to pay the balance off, preferably in a 12-month period, and then you'd push more debt in there. And that way you can be quite specific. And that's where I think the accountability and having the plan can be, really a game changer.
Our next question is if you have any tips on balancing paying off your mortgage as fast as possible with building up savings and investing as well.
Yes, it's a question that we get quite a bit, because we don't shy away from the fact that creating wealth does start with debt reduction. And so we are all about the mortgage mastery first, but it doesn't have to come at the expense of other savings and investments. But I'd always be thinking, what is that money earning you compared to the cost of your mortgage? Because interest rates have been high and the cost of the mortgage has been high for the past few years. And so many investments haven't been, in fact, worth it, because they haven't been returning after tax and fees more than the cost of the mortgage. And so adding into that is the fact that the least riskiest thing you can do with your dollar is pay your mortgage off. So my starting point would be to consider putting extra money onto the mortgage, but I don't mind other investments, as long as there is a conscious decision and a conscious awareness of what each of those is returning you. I think, I meet a lot of people initially who might have sharesies because they've thought it was a good idea to understand about the share market. And over time, we might have kept it there, but over time we've thought, look, it is actually not returning you what it needs to. And so we've actually incorporated that onto the mortgage again, through the revolving credit. And remembering too that we've really recommend KiwiSaver. So everyone should be in KiwiSaver and contributing the same amount as your employers. The minimum is 3%. If you're looking to do more than that, again, I would be looking at, well, what's the cost of my mortgage compared with my KiwiSaver return? I also usually take into account how old you are. If you're quite close to retirement, sometimes I quite like leaving, maximum KiwiSaver contributions, but generally I would say just contribute the same amount as your employer is. If they'll do more if you do, then it can be worthwhile. But definitely, KiwiSaver is a managed fund, so will generally be invested in the share market. So you sort of do have some inbuilt diversification there if you are in KiwiSaver.
Thanks, Liz. Our last question is, what factors should I consider before deciding whether to use the equity in my home for another investment property?
Well, I can't think of any reason not to do it. So if you have equity in your home, and we sometimes call it idle or lazy equity, you should be considering it 100%. That's not to say you have to do it, but you definitely should be considering it if you have the ability to do it. The first step would probably be to get a pre-approval from the bank, because they will be testing it at much higher interest rates. And as soon as you get a pre-approval, really, to my mind, you do it, because if the bank thinks you can do it, then they've taken quite a conservative lens, then you should be doing it. You should at least be exploring it as an option, because an investment property gives you another asset that is going to give you a capital gain and or provide income before and after retirement. So because of leverage, as I mentioned, it is an excellent wealth creation strategy, and I'd be saying you should be considering it right now.
All right, thank you, Liz. I'll leave you to close off.
Wonderful. So I do encourage you all to make an appointment to meet with one of our coaches just so we can understand what could be possible for you.